Are you considering an SBA loan? In this video, I'm going to go over some of the common mistakes that applicants make when applying for SBA loans, and what you can do to greatly increase your odds of approval. While SBA loans offer a tremendous opportunity for financial support, it's also essential that you navigate the application process very carefully so you avoid potential pitfalls. So first, let's talk about what the SBA is. The Small Business Administration is a government agency that's dedicated to supporting and promoting the growth of small businesses. One of the primary ways that the SBA accomplishes this is by offering loans to eligible businesses. These loans essentially bridge the gap between conventional financing and the unique needs of the small business. One common misconception is that the SBA lends money directly to small businesses. The truth is that outside the programs like EIDL and PPP programs, the money comes from banks. The SBA is only saying, hey, if this loan goes bad, we're going to step in, we're going to make the bank whole again. This provides a level of comfort with the lenders and allows them to make what they would otherwise consider more risky loans. Just because a loan is risky doesn't mean it's bad. An example of a risky loan right now would be anything in the retail or hospitality space. Basically, with inflation still high, the interest rates continue to go up, it's uncertain how the economy as a whole is going to respond. But typically during economic troubles, the travel and hospitality industries are the ones that suffer the most. So this is essentially why the bank looks for a rich uncle co-signer. Think of it that way when you think of the SBA. This is why it's good for the banks. Now let's talk about why you should consider applying for an SBA loan. Unlike traditional bank loans, SBA loans offer several distinct advantages. One of the most significant benefits is the lower down payment requirement. With a typical commercial loan, you're looking at least 20% to even get started. If it's a more high-risk industry, they're probably going to ask for 25%. So typically 20 to 25% is the normal for traditional banks. In many cases, an SBA loan can be secured with as little as 10% down. This is making it accessible for businesses that may not have substantial collateral or cash reserves. Another advantage is the longer repayment terms that come with SBA loans. While traditional loans often have shorter repayment periods, the SBA loans can provide terms up to 25 years. This is an extended time frame that allows you to manage your cash flow effectively. Because the payments are typically lower, it's going to enable you to invest in other areas of your business. It is important to note that the SBA has parameters, but the bank you are going through will also have its own set of standards. While a traditional bank may give you 5 years to repay a vehicle loan, the SBA guarantee might allow them to stretch that to 7 or even 10 years. So SBA loans are known for their competitive rates. The SBA sets the maximum interest rate that any lender can charge. That way they're obtaining funds at favorable terms. This can significantly reduce your borrowing costs. This can help you allocate resources instead of paying debt that would go into your business to expand or grow or anything like that. So when I say competitive, I don't mean the lowest. With SBA interest rates, they are lower than you would be given at the same level of risk associated with your business. That's why companies like On Deck, Funding Circle, Fundio, they can all charge very high daily interest rates because it's all due to the risk. So as opposed to those platforms, typically your SBA interest rate will be lower than that. So now that we went over the program, let's talk about the pitfalls that I've seen when going through lots of SBA loan applications. So the number 3 is going to be insignificant preparation. One of the most prevalent mistakes is not preparing for the loan application process. It's critical to thoroughly research and understand the SBA loan programs and which one that you are eligible for. Make sure you at least meet the eligibility requirements for any SBA program before talking to a lender. If you don't know exactly which program you qualify for, the lenders are going to be able to find which program works for you. Many other startups, they fail to provide complete or accurate information or overlook critical supporting documents, which that can lead to delays or essentially a denial if the process takes too long. To avoid this mistake, take the time to gather all of your required documents in advance, such as financial statements, tax returns, and a well-crafted business plan. Just be very meticulous about preparing your business plan and all of your financial statements and your application before applying for the loan. Now, you don't need everything established, such as your EIN, your LLC, or your corporation, but you should have some idea of what name you're going to use or what business structure you're going to operate under. So for your tax returns, make sure that you have the last 3 years of your personal tax returns for any owners of the business. You're also going to have to provide a personal financial statement for each one of the owners, and that form is going to be dependent on which bank you go through. A mistake I see on a personal financial statement is listing the assets that may not only be owned by you. If you have a spouse that is not going to be on the loan, then any joint assets would not be listed on that statement. Also, as far as the equity injection, you're going to want to list that on your personal financial statement saying that you have the equity to inject. If it's in your personal savings, you're going to need to make sure that you have proof that those funds were not borrowed. You can do this by having 3 months of bank statements showing that the funds were in the account, or at least showing that they've been seasoned in an account. Lastly, if you're buying a business, that existing business must historically show that it can repay the loan. So more on buying a business, you can check out this video here. I've seen many borrowers who want to purchase a business only to realize that the business has shown a loss over the years. And each time the seller's excuse is, well, I don't want to pay taxes, so I don't report all the income, but I make money. In that case, there's nothing that the bank or the SBA will do for the loan. If that business truly wanted to sell and would have value to purchase, they would have improved their financial performance enough to make it a viable purchase. If you find yourself in this situation, run quickly away, find another business that actually shows a profit, and pursue purchasing that one. So outside the normal ways of mitigating taxes such as depreciation and interest expense, salaries, some of those other things, there should be no reason that the business doesn't show some sort of a profit or at least enough to show it can pay a loan. Number 2, lack of a solid business plan. Your business plan plays a crucial role when it comes to the SBA loan or any loan process. It's going to be a comprehensive document that outlines your business objectives, what your strategies are, what your financial projections, and how you're going to repay the loan. Unfortunately, many applications either are submitted with inadequate business plans or they fail to provide one altogether. To avoid this mistake, take the time to really think about what you want to do with your business. You're going to put that on paper. It should demonstrate your understanding of the market, your target audience, and your competitive advantage. Show the lender that you have a clear vision for your business and a solid plan to achieve success. The business plan doesn't have to be a novel, it only has to be as clear and concise when it comes to explaining to a lender what you're trying to do. Bankers are really good at financials, but they're not so good at looking at individual business industries and knowing a lot about how they operate. So this is going to be a way to quickly familiarize them with your business and how you're going to operate. Take time to explain what the business is and how it operates. If you're going to purchase a business, you need to address how are you going to run it differently than the current owners. You can say that I'm just going to run it the way they did for 30 years, but you are not them, and you're going to have to explain how you're going to run it differently and possibly even improve the business. When you're writing a business plan, make sure you're putting the good and the bad. It's better to address any obstacles that may come around before your lender has to come back and ask you questions about it. Talk about your competition, talk about the market, talk about the economy. What ways are you going to make changes in order to pivot to make your business a success? If you need some guidance on writing a business plan, check out this video here. And the number one reason I see is poor credit history or inadequate creditworthiness. Your credit history and creditworthiness are key factors that lenders consider when evaluating an SBA loan application. Some businesses make the mistake of applying for an SBA loan without addressing their credit issues, past bankruptcies, or outstanding debts. These all can significantly hinder your chances of approval. The other issue is, before you started your business, you may have used credit cards or other personal loans in order to fund your business, and now your credit score is affected. You want to address that also. So when they're looking at your credit report, they don't see a lot of personal debt that's actually business debt. So to avoid this mistake, take time to review your credit report. Address any issues proactively. Pay off outstanding debts or charge-offs, resolve any discrepancies, and work towards improving your credit score before you apply for the SBA loan. This will enhance your chances of securing the loan and even getting better interest rates and terms. Although it didn't make the top 3, here's a close runner-up. Inadequate collateral or equity injection. SBA loans often require collateral or personal guarantees to secure the loan. Some businesses underestimate the importance of providing adequate collateral, or they fail to inject significant personal equity into the business. This can raise concerns with lenders. They want some sort of assurance that they can recover their investment. To avoid this, make sure you have at least 10% equity injection before you apply. This demonstrates your commitment to mitigate the lender's risk, which is all going to increase the likelihood of an approval. The lender wants to know you have some sort of skin in the game when it comes to the loan process. To wrap it up, the process of applying for an SBA loan can be complex, and there's several common mistakes that business owners should avoid. This can all be done by adequately preparing, creating a solid business plan, addressing credit issues, and providing adequate equity when you apply for your loan. All of these factors should significantly increase your chances of success. Thank you very much for taking the time to watch this video. If you'd like other videos on this topic or other topics like it, please let me know in the comments below. I wish you the best of luck with your business, and until next time, have a great day.